Wednesday, June 28th. This is Market Call. I'm Dan Nathan. That is Carter Braxton Worth of Worth. The Risk Reversal Media global headquarters here in Chelsea and New York City. Carter, thanks for being with us here today. This episode is brought to you by FactSet, our friends at FactSet, financial data and analytics powered by tomorrow. They're powering me today. We miss Guy Adami. Guy is in somewhere in Tennessee, believe it or not. He's actually Guy has he is one of the best. Listen, you guys, you've known Guy for a very long time. Okay, he's been on TV. He's about one of the most natural people I've ever seen on TV. He made a nice transition to podcasting. He also does a lot of live speaking, and he's great at it. He's actually, it's probably one of the best things that he does is live speaking. So he's doing that in front of a corporate crowd today. So he won't be with us today, but he's going to be back tomorrow. Carter, how about this, bud?
How about this? I remember one time we had a good laugh. I think Guy said, I'm sitting next to you. And you go, no, you're sitting across from me.
Yes.
Anyway, I am sitting across from you. And it's a pleasure to be here.
This is going to be fun, man. We got a lot to go through here today. And, you know, one of the things I think one of the first times in the Risk Reversal Media universe you joined Guy and me was early 2021. You were one of our first podcast guests. And a lot of people would say, well, how do you bring a technician on an audio podcast? Because, you know, you're the one who telestrates, you got all your pictures, you do a lot of videos for, you know, Worth Charting. But sometimes it's just fun to talk to Carter.
That's right.
And hear what he's got to say.
And I remember that first effort. We were just talking about the concept of, is there wisdom in price? Right. And that whether you depict price pictorially, which is a chart, or whether you just think about the original tape readers. They were just watching, wow, this ticker keeps coming up. This ticker keeps coming up. There must be something going on. And now this one's up $1. This one's up. That's a pictorial thing a different way. There was no chart, but you're looking at the ticker tape and you're noticing this activity, meaning high activity, high turnover with a stock that's moving up or down typically means something. What are some of the earliest, and I'm sure you've studied this, what were some of the earliest financial charts that came into being? That when did technical analysis, when was it born? And the reason I ask that is, like, everybody in our business, when you started, they give you that reminiscence of a stock operator. And it's a book that was written literally 110 years ago. And a lot of the lessons about trading that they wrote about then, about an actual trader then, are as relevant as they are today. The way they went about it was very different. And it really was tape trading. And the other thing I'll just say is that what you just mentioned, when I started in 1997, I worked at SAC Capital. That's Stephen A. Cohen. Stephen A. Cohen, who's now the owner of the Mets, one of the most successful traders ever. He used to sit there and just look at the tape, and type in tickers all the time. In his head, he must have been making a mental picture of the intraday price action. Well, talk to me about that. That's what it is. And so if you think about it, let's put it in very pedestrian terms. When you're getting a message from something that's happening over and over, a tape reader. Let me use this analogy. If you were blindfolded and you were a checkout person at Walmart, and here come a pair of sneakers, right? They're just telling you it's sneakers, and then there's garden hose, and then there's cat food, and there's an air conditioner, and then here's some record players, and here's a charger, and there's an air conditioner, and then here's some groceries, and here's some other things, and there's an air conditioner. Wait a minute, air conditioner. It must be friggin' hot out. Meaning that's what a tape reader is doing. Like seeing all these things. And so a chart, whether you do it pictorially or as a tape reader looking off the ticker tape, when, you know, U.S. Steel keeps coming up, U.S. Steel, and the stock's up $1, up $2, you're like, a tape reader, a momentum player tries to embrace that and say, there must be something going on. Now, a lot of people want to, and this is perfectly loud, then go inquire, look around, call someone. Is there something going on in U.S. Steel? I don't do that. That's the fundamental part, but one can join both efforts, trying to learn the why. I'm not in the why business. I'm in the what business. I just want to see what's happening. U.S. Steel's on the move. Let's try to play. Yeah, but what you do in that part of your business is that you give a lot of fundamental investors or traders, you give them an important input because you've already recognized something important. They look at you and they say, okay, well, here's a guy who's really good at this. So let's figure out the why, you know what I mean? Right, and so that was my job. I worked for a guy who was just a momentum trader. And until he told me, go figure out why this is happening, or go figure out why that analyst upgraded the stock or something like that. So to me, I think all those are really important inputs. And we talk about these sorts of things that we all rely on when it comes to trading.
we get also really bogged down. We're also, in the pundit business a little bit, right? Like if you think about it, we show up on CNBC, we offer our sorts of views, and we end up being a slave a little bit to some of the things that drive narratives, right? And so one of them right now is clearly the Fed Chair Powell. Okay, we just had a meeting a couple of weeks ago. They did their pause. They did indicate the fact that they're going to likely raise 2 more 25 basis point hikes this year. What he said today was really interesting. He's over in Portugal and he's speaking with Lagarde. He's speaking with his counterpart in Japan and England, that sort of thing. He basically said that they're not sure that right now policy is restrictive enough, that they're not ruling out that those 2 25 basis point hikes don't come consecutively. So that had a certain hawkish tone to it. So when you sort of see that, and we saw some volatility today, okay, we started the day with this Wall Street Journal story that the Biden administration may strengthen some of the bans on advanced chips to China. And we saw some of the biggest leaders in the market. NVIDIA was down 4.5% on the opening. So we were down. And then that hawkish rhetoric wasn't great for the market. But then we rallied 30 handles. And it seems like there's a lot of 30 handle rallies in the S&P 500 right now on a 4,400 number. We're seeing that a lot.
We are. And even though sort of volatility of VIX is very low, we're getting a lot of intraday reversals, right? Where you're up quite a bit and you give it back, or this morning down quite a bit and then recover and go back to unch, but we are unch.
Yeah, let's pull up really quickly the NVIDIA day chart just to show this. Like, I was looking at it at 4 a.m. when, pre-market, and there's not a lot of volume, but, I saw that headline when I woke up. It was down, 4.5% or something like that. It was nearly unchanged, okay, on the day. And then you look that it's kind of giving some of that back right now. So to me, again, why are we focused on a name like this? Well, it was A, part of that headline. B, it's a $1 trillion market cap company that's gained $500 billion in just 5 or 6 months or so, and it seems to be very much at the core of the excitement, Carter, about the market here. How important? Maybe they can pull up the SMH, the semi chart here. How important are the semis to you as you think about as a broader mosaic of different sectors? You keep hearing about, well, we better see some of these more cyclical sectors, and this is a very cyclical sector. It just happens to be wrapped up in something right now. Start to participate a little bit in this.
And they have to some extent, but not to the extent where it would really validate the crowding, right, in certain areas of the market. Semis are very cyclical. There is a general view that's creeping into the investment community that they're going to be less cyclical than they've been in the past. We shall see. But in NVIDIA, we know if you look at the market cap of all stocks in the Philadelphia Semiconductor Index, I think NVIDIA is 30-40%, and the top 2 are almost 50. And so this is the whole shooting match. And we know it had that huge re-rating on the 25th and then followed through. But basically, after that second day of follow through, we moved above 400. We're sitting at that level. So
bullish or bearish, that consolidation at 400?
Well, so what it is at least as I learned it, when you gap up a little bit or gap down a little bit, you're typically in response to news. And if it's 3 and 4%, there's follow through. But when you get a really epic gap where you get re-rated, let's take something extreme, an FDA approval, and you're up 30%, you don't budge because markets are very efficient in getting you to where you belong when it's big news. So notice NVIDIA, that was big news, right? That was the big PMs that I talked to, a lot of them page 1 holders. They're like, no, this was such a blowout in terms of what they're saying about their growth rates. That the stock moved so aggressively that I think it kind of doesn't move here. You'll see this back and fill. Like I would sell volatility.
So if you're long the stock, you'd sell like strangles against the long stock or something. Let's pull up AMD for a second, because what's interesting about the re-rating that you talked about in late April, or I guess it was in May, in NVIDIA, AMD went up in sympathy with it. It gapped similarly, not to the extent or anything like that. So now that's filled in that gap. And if you look at that breakout level, going back to, let's call it August of last year, right? I think, and I don't mean to put words in your mouth, you say, well, it did what it was supposed to do, right? It checked back it filled in that gap and came back to the breakout level. How are you thinking about, forget the fundamentals here, how are you thinking about a chart like this?
Well, first, happily, I don't know anything.
Well, you don't have to forget.
I don't have to forget them. They're not known to me. But what we do know is, just as you've articulated, the stock did gap up on the same day. That would be the 25th of May, and now has retraced all of that. So the question is it down to support? It's down to a level before general news, not specific to the company, but general semiconductor news was released, NVIDIA, of course. But it's not really all that big of a level of support, I would say. And this important too. Remember, support is not a plywood board or concrete floor. You get down to support and then you can sink into support, right? It's like a little bit like a child jumping on the bed in the hotel room, meaning the top of the mattress, but you can go into support before you ultimately find support. So it's down to support, but support goes all the way to 100 and then some. Stocks trading, I'm looking at my facts at here, 109, 66, 67. So buying it here, no, I think you probably get it at 100.
Okay, that's really interesting. One last question on this. So you just spent what 2-3 weeks in Europe meeting institutional clients. These are investors who primarily, obviously, they have allocations to European equities or global equities, but they're focused on U.S. equities because that is what you do, right?
It's not so much that, whether it's that the U.S. market is such a bigger market than any other market that most of the long short hedge funds have U.S. exposure naturally, or some of them are dedicated only, and even the sort of EU-based only or European equity only or global equities, they still have U.S. exposure. So, but listen, conversations will go from Royal Dutch to British Tobacco. It's ever thus. The point is that, of course, a chartist is agnostic. A chart is a chart, and I try to offer judgments.
But you're speaking to a lot of PMs, portfolio managers, who, again, like we just started out this conversation, who use lots of different inputs, right? And so, so my question to you is, after spending a lot of time, you going through charts, but then you discuss, you know what I mean? You're just like having like qualitative conversations about the market, about sentiment. How did you feel European investors are relative to U.S. investors about this phenomenon that has really powered our stock market this year about AI? Now, there's not that many ways in which maybe companies that they come in a lot of contact with on a daily basis over there are exposed to this, but here we are. And we're also, I don't know why, we seem to be very focused on whatever the latest thing here is in the U.S. Is it less so? I'm just curious, like, what was the sentiment?
But I mean, I'll give you a great anecdote. I was in Toulouse to start the trip, which is where Airbus does their testing and so forth. But probably 40 minutes outside of Toulouse, in a town that, my God, you practically have chickens running through the road. There is a sign up in front of a building that you would think looks more like a garage that said a center for AI. And you're like, I don't think so. Meaning it's people believe in it and people are embracing it, but it's taken on a little bit of a fad when you start to see a freshly printed sign. They don't have Kinko's there, but they've gone and put up a sign holding themselves out as a center for AI research. And it looked like a garage to me. All
right, fair enough. All right, let's broaden this conversation out a little bit. Let's look at the S&P 500 here, because it's funny, when the S&P got above that August 2022 high, right? And it got to what, 4460 or something like that. And, then it kind of retraced a lot of that move, not a lot of that move, but, a bit of that move last week. And if you're bearish as I happen to be at the moment, you thought, well, maybe we're at the start of something. You got a little bit nervous about quarter end sort of window dressing sort of thing. And, if you look at it and see the way the market came back yesterday, the way came back this morning, maybe that's a bit of it. Talk to us about the S&P, how you're thinking about it. We're kind of coming into quarter end here. It's half the year. We're up nearly 14% of the year. What are your thoughts on the S&P 500?
So there are two things that obviously are important, and it's not new. I've said these things. You've said these things. Everyone knows these things. But we know that the S&P, at least for what we have, is the, quote, standard to measure equities in the United States. It used to be the Dow Jones Industrial Average. Now it's the S&P. But the S&P has this circumstance because of its market cap weighting that it is being driven by a handful of stocks. And the juxtaposition between the equal weight and the actual weight remains extreme, with the important note that there has been some now increased participation in laggards. But still, the bifurcation is extreme, and it has to get reconciled. And it's only one of two ways, right? It's that the laggards really start to come to life, and sort of you get convergence, or the steep, and for now, that's what's been happening of late, the steep uncorrected NVIDIAs and Microsofts start to mean revert and give back. The one that hasn't, of course, is Apple. But let's look at some charts here. We've got one. I've got a nice big red circle there on that August high. Of course, now if we do the next, let's do a horizontal line. Interestingly, this little 3% dip, it found support to the penny. Now, again, is one prior day's high support? Of course not. But it's a reference point that everyone whose eyes are working can see, hence mine are working. I have contacts in the 2020, and I drew the lines that way. The point is, we're all looking at the same things. Now look at the next iteration. This is basically what we have. So do we sink though down towards the uptrend line, the intermediate uptrend line in effect since the October low? So put in, for instance, the next, and you'll see here, this is the sequencing that's been in effect since that October low. And one more iteration, if we can do it, and remove that trend line. And so I've got a question mark there, right? Do we need to correct, dip, sell off, drop, decline, doesn't matter what words you use, to stay on sequence? And I suspect that's what's coming. We will have more than this just 3%er, that this little update today is not the beginning, and we're fading here. We're down again. It's that this is, it's corrective. And I know that's, look, in the etymology of the word correction, it implies that something's incorrect, which it is. It's like, listen, I one of my first jobs, I was a cold caller, and this guy was at Dean Witter of all things in Boston, and he was a maniacal horse gambling nut. We'd go to the track. He'd say, "Come on, hang up the phones. We got to go to the track." And he would win. He'd sometimes have these wads. This is in the 80s with 6-7 grand trifecta. But here's where I'm going with this. Sometimes I know nothing about it. They get out of the gate. The horses are running for all of 5-6 seconds, and he scrumbles up his tickets, and we walk out. I'm like, what's he doing? He knew right away that when that horse that he bet on was too fast, he could never keep up that pace. I go, it's not even, we haven't even done a little bit of the race. He goes, that horse that I bet on, when he comes out that fast, there's no way he can win. And guess what? Sure enough, he was leading, and all of a sudden, the goddamn thing was a donkey. It came out like a mule. It was the last one in the race. But the point is, we've got that circumstance here.
Yeah. Well, it's interesting, Carter. Any data or do you track like this quarter end sort of stuff? We're
there's a little bit of that. The pejorative thing is called window dressing.
Yeah.
Right. That big PMs, because they get paid as a percentage of AUM.
Yeah.
So they said, let's run the stocks
We'll deal with the early next month, early next quarter. We'll deal with the dip.
We'll deal with the dip, but let's pump it up because we get, now that's very cynical, and who's to say people do that, but things go on.
Well, it's funny. And the only reason why I mentioned that is that, when you see the dip buying on the last week of a quarter that was very good, a half year that was very good, it's maybe not that hard of a justification to do that. Let's look at yields for a second here. I know we spent a lot of time on the inversion, but the 10-year, the tension's building. We're at this kind of 371 sort of level here. I think last week when we talked about it, you thought a pair of twos. I'm not going to ask you which way you think it's going to break. I mean, listen, if it breaks lower, we know that the support is 335 or something. Okay, all right, you're in the lower camp. Yeah. What would that mean for stocks right here, in your opinion? And this is, again, this is qualitative, but if we were to see at a time where the Fed's being a bit hawkish, right? Fed fund futures, if you look at the CME Fed tracker, it's pricing an 80% probability of a 25 basis point hike at the next meeting. So that's more on the short end. But if yields were to come in, let's say 30 or 40 basis points right now, and they're going to break down on the 10-year, would that signify, let's just say that you and I can agree, that signifies a further weakening of economic outlook, that sort of thing, good or bad for stocks with lower yields?
Yeah, I mean, I think the knee-jerk reaction always is, it's built into the psyche. Lower yields than we can, long duration assets, we can ramp the P, right? So the question is that the case? At some point, lower yields are a function of something that's unhappy, right, on Main Street, on economic or otherwise, right, recession. Now, some of the data, we have all sorts of conflicting views. Well, and we can look at it possibly as the 10-year spread. Yeah. But this setup here is very tight, just so you can feel the tension. And there is what makes a market. A lot of people who are playing for much higher yields, and a lot of people say, no, the yields have peaked. I think the peak is in. We can look at a longer term of the same iteration. So that's picking up that shocking low of 38 basis points on the COVID plunge. But basically, here we sit. And so it is a pair of twos, and now you make your bets, or you could say, I don't want to bet. Pair of twos is not a good hand, which it isn't. It's kind of a feeble hand. But my bet is lower yields. And if we look at a long-term on a log scale, we overshot the trend line. Checking back to it is normative, if you will. So that's my
2.5. I mean,
well, it depends how quickly you get there, but that's right. It's lower.
Yeah.
That's for sure.
It's funny. I'm also in that camp. I think you and I are in agreement. A way to play that is long TLT. You could also do it with options. TLT is usually a very low vol sort of instrument in the options market. So I think that's interesting. I've been long of the TLT, looking for a move there. Let's talk about the 210 really quickly, that spread, because Guy has made this point on many occasions that we're at 1% ish or something like that. It's been a year that we've been inverted. We can go back and look at that 06, 07 period where we inverted, but we were only inverted to about 25 basis points. And it was a long inversion too. But ultimately, you'll hear this also, that the re-steepening of that would be for the wrong reasons also,
right,
and therefore might not be great for stocks. And the way I would think about it is maybe it would be stagflationary, right? If the long end is coming, in, but the 2-year, the short end stays bid, that's because you're worried about inflation on that end. But on the 10-year, it's a growth thing.
Right. And there's, people say bull flatteners, bear flatteners, but what we do, and this is an all data chart, at least all the data that I have, going back to the mid 1970s. And if you look at those other prior lows, right, where you have those spike lows, those were not good times to be long equities.
Yeah.
Generally speaking. So the question is it different this time? There are a lot of conflicting data points, of course, but the messaging from crude being a little bit heavy, Germany is in a recession, the 2-10-year spread and other things, I think caution has been thrown out. I don't think there's any caution at all anymore.
Doesn't appear to be. I mean, and we mentioned the VIX before. We had a great guest, a guy named Stuart Kaiser, who's the head of equity trading strategy at Citigroup on Fast Money a couple of days ago. And we talked about the VIX. And, it's funny because I spent a lot of time, obviously, in the options world for a long time. And I know that just looking at spot VIX is one thing. And this is like looking at the futures curve is another. It tells you a different sort of thing. And he made the point that if you're looking a few months out, the curve of VIX futures is saying something very different. It's not screaming 13 complacency, right? But that's a function of the big money and how they hedge and how they use futures and different products to do that. But I think it is simple enough to say a VIX spot at 13 right now, or 13 and change, is screaming with an S&P that is very near 52-week highs, up 25% off its October lows, is screaming a level of complacency. Also, when you consider the concentration and then the disparity between the market cap weighted and the equal. Equal weighted.
And now the question is, of course, a lot of people say that it belongs here in the sense that because of the market cap weighting, because of the steady, deliberate, strong nature of Microsoft and Apple, not to mention others, that actually the market's construction is okay. History reveals that when everyone likes something or hates something to an extent where it is just literally embraced above all things or abhorred above, it's usually right to take the road less traveled.
Yeah. All right. So here's one where you could have been this way, and you just said that crude has been heavy. Let's pull up the day chart here. It was heavy about 2 hours ago, and then it ripped. I mean, literally, it ripped from like 67 and a quarter to where we are right now at 69 and a half. And crude oil, that's not an insignificant move. You know what I mean? And granted, yes, it's been banging around like 2-3% if you look at this kind of tight consolidation on a kind of, the last few months or so. But talk to me a little bit about crude and what you think that heaviness is speaking to, because there's a couple ways you could think about this, right? The dollar's come off, crude has come off. We've seen a lot of other inflationary inputs come off. That's good for margins if you were worried about, let's say, companies and their ability to pass through some of like these kind of higher inflationary inputs, that sort of thing. So that's good here. So talk to me about what crude's saying to you. And we can obviously go back to the fact that the Saudis cut production and crude didn't rally for more than 6 hours.
Right. So look, my own hunch is it sometimes, and there's no technique to this other than that's what a hunch is. When the pattern is so obvious, like, my God, this thing is clearly rolling over, it's going to break. Quite often they don't, right? I mean, we all can see this thing is hovering there. It's going to drop. The recession's coming. China demand. You can weave any narrative you want into your mind. But I just think it's not going to do that. It doesn't make it all that great along. But if I'm forced to act, I want to buy here, not sell here. It seems that it's too obvious that it will break.
Yeah, it's funny though. I just, again, going back to the Saudi comment or whatever, I mean, China is stimulating. So you would think that would start something. It doesn't act well in light of some of those headlines. So to me, I'm probably, I'm on the sidelines on this one, and something really bad would have to happen, I think, for it to actually get back above, like, towards that 150-day moving average.
And to be
which
fair,
is
the
like
energy stocks don't look good, right? Exxon, Chevron.
But one thing I'll say to you is maybe they can pull up that chart back to the S&P 500 where you were showing the question mark with a potential 8.5% drop to the uptrend. Listen, while I've been bearish and I missed a lot of this stuff, I've actually traded well on the macro this year, like some of these instruments that we've just talked about. We're going to get to stocks here in a couple minutes. But listen, if the S&P were to come back to that uptrend, I think there would be a lot of buyers, Carter. If there was nothing. And so then the question is, if you're some Google or your favorite AI stock or whatever, if it had a little fear put back into it, that's where, if you missed it, okay, then you may want to get into it. But might you be interested in looking at the OIH or the XLE or maybe the XLF? Again, I have a bearish position in the XLF. I don't think this earnings period is going to be great. But if the underperformance is reflected when the S&P corrects, okay, and there's fear put, then I might start dollar cost averaging in some of these cheaper sectors that might already be discounting like a soft landing, if you will.
Well, I mean, just to put this in context, if you were to look at a long-term relative strength chart of the energy sector to the S&P, we got down. So Cisco's worth more than any company in the world in 2000, and energy was thrown out. No one wanted transports, trucks, rails. They didn't want energy. And on the COVID sell-off, we undercut the relative low of energy to the market. We then rallied. It was the best performing sector for 2 years. We're now back at that level. I think this is what you're implying is one's right to be contrarian here. And it's interesting. If you were to just do a simple poll, I wonder what the response would be. If you can't touch it, 12 to 18 months, you have two choices, AAPL or XLE. I don't think it would be overwhelmingly Apple. I think, in fact, it might surprisingly, a lot of people would say 12 to 18 months can't touch it. I don't know. I think I might drive energy.
Apple's gained $1 trillion in market cap off his lows in the last 6 months or so. I mean, the one thing I would just say there is, like, for me, why am I focused on that uptrend that you drew? And like a proper 10% correction, okay, would put a lot of fear back. It would basically start pricing in a recession that might be a little more than what some would view as a soft landing. And then at that point, let's see how some of those groups that have been underperforming, let's see what sort of relative strength that they show. Because if everyone heads for the door and the Apple, the Microsoft, this and you see money flows start going to those other things, that might be the right time.
And also you can get the circumstance where, as of now, that people say it's never going to correct, right? You can also get certain that it does what we're talking about, and then it doesn't stop.
We know it's going to correct.
And then it doesn't stop. It goes down 12, 15.
Well, all right, so Danny Moses says that. Okay, so Danny has said this in some of these names that are really
people won't step in.
What's the buy point? You know what I mean? And he and I go back and forth on that because I think that we are all conditioned. I think even the crash that we had in 2020 conditions us to do this, is that the powers that be will do things. They don't want to see financial markets crater. They don't want to see protracted bear markets. I mean, I think it's probably really bothered Jay Powell, if you think about it, that they've raised, interest rates 500 basis points, the quickest they've ever done that. You know what I mean? And the housing market really doesn't budge. The stock market went down for a year, you know what I mean? But now it's right back up to where it was. And that is kind of frustrating, I would assume, for them.
Well, we know that they're very aware of stock prices. In fact, we know the government is one of their leading indicator inputs, stock prices. And so the strength in the market is surely discussed behind the closed doors as giving them cover. That do we push more? Do we raise more? If the market were down at the lows, they would be a little slower to act. But with the market up, it gives them the ability, to some extent, one of their inputs, to actually say, we can stay the course.
All right, let's talk about some single names before we get out of here. Here's one that just caught my eye. It was up like 4 or 5%, and it was Pinterest. And if you go back and you look at, I think it was late April, early May, when they reported their quarter and the guide, I mean, you could see it was a 20% gap. I think it went down 25% that day. It went down for a couple more days, and then it filled in that gap. And then today you have an upgrade at a brokerage house, and the stock's parting. You know what I mean? So when you look at that sort of price action, where it was clearly a move on fundamentals that people were selling it down 25%. Okay, that is a concerted decision to do that. And I'm not saying the same people are buying it here, but when you look at now on a 5-year basis and you look where this stock is trading, it's kind of interesting when you go back to those kind of 2020 levels before the COVID stuff, where everyone was pinning. Remember, everyone was pinning stuff in the summer of 2020. I think maybe they were, maybe they weren't. What is this chart on a 1 year And then like on a 5-year basis, what is this saying to
the
you?
one that's on the screen here, the 5-year, the point is that we've had so many of these round trips.
Yeah.
When you have that much excess, I mean, think about it, right? You're talking about 10 to 90. It's very hard not to give some or all of that back. History reveals this. And so this is not what's important, unique or idiosyncratic to Pinterest. They're hundreds with Peloton and Zoom, and it goes on and on and on.
Yep.
The more sort of, I think, relevant chart is the one you started with, which is the here and now chart. After it dropped and gapped, the short-term chart, we can pull that up, is after this sequencing, what typically happens, right? And so the definition of supply entering the market, there's two types. There are people who bought in March and April, right? Just before the damn thing collapsed. Okay. Not their fault. We've all been there. Okay. So a certain number of those people, as soon as it was indicated down there where they dumped it, they're like, first loss, best loss. I got to get out of here. I'm wrong. Okay. But there are a lot of people who say, I can't bear to sell it. I can't believe this happened to me. Damn it. But then they say, I don't want to dump it. Okay. And so then they say to themselves, I'll end run this thing if I have to. I'll ride this to zero. I'm not going to be the person who dumps it. And then when it rallies back, I'll have two mistakes. I've got one mistake now. I bought it. And now it's down on me hard. If I dump it, it rallies back. I got two mistakes. It's fatal. I'm not going to be that guy. I'm not going to be that woman. But now that it's rallied back, you've returned to where they entered. They, not all the people are still there, but it's where there's one kind of supply, people who bought poorly, not their fault, who now are being given the chance to get their money back even. And a lot of people seize on that. So that's one type of supply. There's the exact opposite. There are people who bought at the low. Dumb luck or brilliance, right? The most astute, biggest hedge fund manager or the most hapless E-trader or Ameritrader who nailed the thing at 21. You know, when you buy something at 21, they flip the cards over and show you 27 or 28. That's another kind of supply. You're like, I got to grab this. This is crazy. I can't believe I got so lucky, or I'm the smartest guy in the room. But either way, you're at a level where supply from below, supply from above, and that makes this not a buy. It makes it.
And then when you broaden it out back to that 5-year chart, you say that that's also a level. Okay, that honestly, that was awesome, and I really appreciate that. I want to go to a 1 year of Snap. Okay. And I think every time I put a Snap chart in front of you over the last year and a half, you basically you're going like this to me. You've been a seller. And so there you see that
trying.
It's trying. And it's a tight consolidation. There's lots of gaps there. I think the most important, it filled in its earnings gap too, not in the same way in which it was kind of slower steady. And then if you pull up a 5-year, you know, it basically looks the same. Okay. And they're both like $18 billion enterprise value companies. And is this the same story for you?
This is better.
Okay.
All right.
So why is this better?
There are a couple of reasons. So one could say for starters, Carter, this one dropped and gapped just the way Pinterest did, and it didn't hit its head.
Yeah.
Well, what it did when it got back there, it backed and filled for almost 2-3 weeks. And now this continued strength, by my work anyway, the stock qualifies as a bearish to bullish reversal buy. Okay.
Another one. We'll do this like a speed round here. Robinhood. Okay. Here's one. This is really important. Sometimes you don't care about stuff like this, but here's a company with a $9 billion market cap, and they have $4 billion in net cash. Okay. They just made a small acquisition, but a strategic acquisition. They bought a startup company, a credit card company. They're starting to broaden out their offerings and this and that, whatever, you know, so like, this is a company that was like a poster child for like the COVID bull run and this and that, whatever, and then it blew up. And then what is I know you don't care about any of that stuff, but those are some of the things I think about. What do you think of a company like this where I say maybe the fundamentals have bottomed and it's got a good balance sheet? And you know, I'm just curious, like thoughts on this one?
Right. So the chart is the same, right? We have the precondition of an epic run up, an equally epic collapse, and now basing, bottoming, trying to get out of the mess that it's in. Not as good as, and I'll get the symbols right. Pinterest was the one I don't like. Snap. Okay. I like Snap. This one's sort of in the middle of the two.
Okay. Fair enough. All right. Last one here. And this was in a worth charting email today that I got to my email box here. That's where an email would go, I guess. It would go to your email box here. And this is a name, Comcast, which is the parent company of CNBC, which is, you know, a network that, I mean, so you probably weren't going to put out, just kidding, a negative report on the Comcast here. You wouldn't have cared one way or another.
No, I never do that.
So talk to us a little bit about what you're seeing in Comcast. And again, I know that you've been kind of fading almost every rally, it feels like, in the last year in Disney. I can't remember. There were too many times that you're particularly constructive.
It's just not working. Right. But so for starters, Comcast is the 40th largest stock in the S&P. It is a big player, right? And we'll move through these quickly. This is an all data chart, and what it's worth, we'd all agree it's moved, generally speaking, in its lifetime from the bottom left to the top right, uptrend intact. Look at the next iteration. This is annotating every 50% drawdown in the history of the company. You can see them there. Let's put the trend line back in. So we have a stock that now has dropped to such an extent, and interestingly, is bouncing to the penny off that trend line. But let's look at the here and now, and then more immediately. So this is a 5-year chart. You have that clear bull phase, right? 2021, and then it breaks trend. Look at the next one. There's the bear phase, and then it started. So if we could toggle back and forth, first one, the second one, the first one, the second one. You have the great run up, the great collapse. Let's put them together. So now there they are together. What those are trend lines, of course. And the way we try to do trend lines rather than having to be up all night drawing them is use a moving average. So look at the moving average. Let's take away the lines and just do the moving average, right? And so what we have is all the elements of a bearish to bullish reversal, at least to my eye. And you can draw other annotations. Take a look. We've got, you could call it a cup and handle. You can call it an ascending wedge. Look at the near term. This and final chart, we have it here. This has all the tension one wants for I would say, a breakout above these intermediate tops. I would say playing for 45 to 48.
Yeah, that's a great looking chart too.
Yep.
I agree with that. All right, well, that's going to do it for us
That's
here.
gonna do it.
Carter, it was honestly awesome
How
having
fun.
you here,
Yeah.
like to do this. And you know, some people ask, like, you know, they see us on CNBC and the great Melissa Lee as she's directing traffic and this and that, whatever. We kind of have to kind of fall into line a little bit, but it's really fun doing this because like this is the way we might be talking. If I said to you, hey, come over, let's have a sandwich together in the middle of the day and let's talk about the markets, like this is the sort of conversation that we might have.
And interestingly, for what it's worth, this is what, when you're sitting, not when it's an auditorium, you're giving a presentation, but when it's 6 people at a table or 2 or 3 different pods, this is what a business meeting is when it comes to market. You talk about individual opportunities, whether it's fundamental, technical, quantitative, and then people bat them around.
Yeah, well, that's it. All right, listen, man, we appreciate you coming down here.
Bet.
We did buy you a sandwich for coming down here, so we appreciate it. Like, thanks to our sponsors, FactSet, and they've obviously been great partners. We rely on them for all of our data and analytics. We'll be back tomorrow with Liz Young, that's EY from SoFi. Guy Adami is going to be back from Tennessee. Maybe he brought us some, I don't know, maybe he brought us something cool from Tennessee. You think he did that? All right, maybe he did that.
At least.
All right, exactly. All right, Carter, thanks for being here. Thanks for all of you guys for joining us today. We'll see you tomorrow with Liz.